Hi guys, taking you on in on a ride, uh, going through my portfolio and studying more the Kelly criterion numbers of and judging whether how much you allocate to each um, asset class or each investment category, because I think this is a very important practice that I also don't do very often. I improved my investment sheet a lot by including this tab always, and reviewing it from time to time, in order to come to a rational recommended Kelly allocation for each potential for each investment that I'm interested in. And also keeping it simple, not doing it for every stock, but per category. Because I think that in investing, I've made great progress over time. I use I have risked a lot in I have done very concentrated investments in the past. In crypto, I went to 80% allocation in 2015. But there was good reason to. The market had crashed a lot, and the fundamentals looked very good. It was justified, but it was a very concentrated position, a high risk. I also did that with Tesla. I went to a 50% allocation last year in one stock. That was a high allocation also, but it was justified because there too the price had gone down a lot from 400 at the peak to just below 200. It was lots of negative sentiment. In the meantime, revenues had tenfolded. So it was very, very bullish, and it was worth taking a high concentrated position on that one stock. Or at the time when I went to 80% crypto in 2015, I was still Bitcoin mainly. But I also was investing in smaller coins. Then I had like 50% Bitcoin and 30% NXT or so. When I did these high allocation or high concentrated positions, sometimes the market gives you an amazing opportunity that you believe very strong in, and you can do that. But that's rare. It doesn't happen often. Like right now, we're in a market that doesn't give such opportunities, in my opinion. But if you see one, please let me know, because it's what I'm looking for, like an amazing opportunity. I don't see that right now. I see okay opportunities here and there, but they don't justify to take a very high position in. But okay, that's what's usually the case, and so you need then to have a portfolio where you, well, have a diversified portfolio, bet on different things, and likely some will pan out and keep the returns of your portfolio elevated, and that's the whole point, of course. And the biggest problem, of course, it drains on performances is cash. Cash is a money loser. You lose 5% per year on it. But if you want to have 40% per year, having a piece of your portfolio losing you 5% per year, you need to have how much higher returns in the other investments to make up for such loss, and that's of course not going to work. You really need to deploy all your capital in good investments in order to have high returns. So this is the biggest mistake I have made, I believe, in this year 2020. Usually I'm always invested fully. I was wise to actually go fully out of the market right before the corona crash. Then the crash happened. Then I went fully back to 100% allocation. But then I was too quick to lock in certain profits towards cash, and then I've been in about 30% cash the whole way basically already half a year now, 30% cash, and that's been a big loss in opportunity for me. So that's my biggest challenge, to deploy the cash, and it's not easy because it's that bear inside of you that keeps you in cash, and wants to like keep cash on the side to buy to find opportunities, but it's not and to wait for opportunities, but it's not a rational approach, because if you have different kind of investments that are uncorrelated, but they are all good investments, then if the market turns around and prices go a certain direction and there are opportunities somewhere, then you will be able to sell some investments that performed well for other investments that are at an opportunity stage. So I think that's my biggest challenge here, to get rid of the cash. And also, I think what I have to learn is to use margin, something I never did. But it does make sense, especially if you have a diversified portfolio. And so the risk of your portfolio is overall actually not that high. Then you can afford to use leverage, meaning borrowing money from your broker, or from in crypto also you can borrow money against your crypto, and in real estate you can do that too, and at very low interest rates. With broker interactive brokers, it's maybe 4% or so, or 5%, which is way below my investment returns of 40%. So that's certainly worth it. But of course, only when there are opportunities, only when you invest in opportunities. But that's something that I am starting to consider. I haven't done so. I'm not at margin. I have even cash. But I really want to aim to go to 0% cash, and even to minus cash, minus 30% cash here. Because if I have a portfolio like this, where so the way it works here is, I have like targets. Okay, if crypto corrects 30%, I want to go. Then these, in my opinion, are the risk reward ratios. You have an upward potential about 15x, and the probability that's going to happen is high. It's 80%. But of course, even if you correct for 30%, you can go even lower. You can go down another 20%. But what's the chance? I believe that's very low. That's only 20% chance. And so if you put these numbers in, Kelly recommends 80%, but then you have to decide you're going to do half Kelly usually. But in my case, I would do a lot more than half Kelly. I would do 80%. And so that would be a recommendation of 60%, 64% crypto. If that scenario happens, then I would go to 64% crypto. And that means that, well, currently I'm at 45, I would drop to about 40. But that's also in a scenario where other assets also crash 10%, 10%, 20%. If they all crashed a bit like this, then my crypto allocation will only be 40%. I would bump it up to 60, so I will have to buy 24% crypto. And at this point in time, actually, I think I would invest in more Ethereum, because, well, I already have a major position in Bitcoin Cash, but especially I've noticed in my last video I made one mistake. Emperor wears no clothes, where I said that actually there is not a single coin that where the amount of transactions has outperformed the price rise. That's not correct. With Ethereum, actually, the price rise is about the same as the amount of transactions that went up. So Ethereum actually is doing very well in the amount of transactions, especially considering that it is expensive to transact on Ethereum. And then still, it has seen major growth in amount of transactions the past half year since its low in price and in transactions. So I think that's something very, very bullish for Ethereum that should be rewarded. But okay, we'll see if it happens. This is, of course, flexible and changes over time what I decided to buy. Short gold, I'm at minus 31% because I closed the short silver that was part of this, but that I didn't want to keep So it used to be minus 34%, is a bit less. So I continue to bump this up to the recommended killer allocation. I continue to sell more gold GLD shares into the market short. I think now is the time to do that because I think we have reached the peak already in gold. I think that's probable, and so what's not being sold short now will also not be sold short in the future, probably. So it is very important, and I continue to push this to a higher exposure that is rational according to the Kelly criterion. But okay, this increases actually my cash position, and so it increases my cash problem. But okay, it's a good problem to have too much cash to invest in the markets, especially looking at the opportunities. So tankers, I have actually bumped it up once. I was maybe 35%, it dropped to 30%. I bumped it up back to 35%, and now we're back to 23% because they've gone down and my other investments have gone up. So I could bump this up again, and I'm starting to consider that now that I'm open to have margin. I have more room to invest in stuff because I'm okay to go onto margin if these kind of opportunities present themselves. If tankers correct again 10%, yeah, I could bump it up to 34-5%. But as of course all given, these calculations are correct. And that's very important. So I would love to have your feedback and know what you think of my estimates here and if they are right or wrong. So for example, for oil tankers, I believe that potential is a 5x. If it drops 10%, again, the potential is a 5x. Many of these companies can do a 10x. They can over the course of 5 to 10 years. But of course, if you did a 5x, you're already in overvalued territory. So yeah, but this is based on the idea that the oil demand will continue to go up as the economy recovers, and even though we have the EV revolution, overall oil demand globally will continue to go up. As I believe that does take time, the EV revolution, and the EV revolution causes a lot of electricity demand where, well, they haven't found a great solution yet because they're not embracing nuclear power. So they build lots of coal plants, but there are also oil plants, and so even EV cars increase the demand for oil because the way electricity is generated. But so I think just because of the global development, especially, so many countries are developing fast in Africa, for example, and that's just like increasing oil demand. There are no EVs in Kenya, where I live. And it will take 5 to 10 years before that also starts to be used here and starts to impact oil demand. So I do think that there is another bull market for oil tankers. I mean, the chances are good for that. But I wouldn't say it's an amazing investment, no, because the big problem here is, of course, you're not investing in the future, and there is risk in that. You do need other investors to pump the value of these oil tankers. I mean, they can make tons of money, but if there is shortage in the amount of tankers, they make tons of money. Yes, but if investors don't bid up the value of the stock, well, it's not gonna work out, and that's the big risk here. You do need others to join, and since it's in the traditional oil industry, that might be a problem. So but there are so many signs that it's a great investment. If you look at, I mean, the amount of cash they make, they do buy their own shares in the end, and that inevitably pumps the value of the stocks. There is a real a force there that's also like, it doesn't matter who buys stocks. It can be new investors or it can be just the companies themselves. That doesn't really matter, and that force is quite certain to happen as long as they don't start ordering more ships, which is happening a little bit. That's a problem also. Everybody wants to make money, and the big bullish case here is that shipping rates will go up while they won't order new ships, and so there will continue to be a shortage of ships. I think you can make a rational case for that, but that's not a certainty. Also, um, some actors may spoil the party by just starting to order lots of ships, like the Greeks can do or the Chinese can do. And in that case, that might spoil the bull market also. But what I really like about tankers is uncorrelation. It's really not correlated to the other investments I have, like crypto or shorting gold. It's actually inversely correlated. If I'm wrong about shorting gold, and we have not only a gold bull market, but also a commodity bull market coming up, and oil will go up in value, that will certainly drive a new boom in oil tankers. So because the last boom in oil tankers was from 2000 to 2008, right at the same time with the commodity boom. So if we get a commodity boom, and I'm wrong about shorting gold, I lose lots of money on shorting gold, but it's very likely that tankers will go up a lot, and also I like that. So that would cover my loss. But of course, I'm not investing in inversely correlated things to hedge myself. No, I believe both of these have a good chance to work out at the same time. I believe it's likely gold will go down in price over the next few years. It's likely we will not have a commodity boom the next few years, but it's still likely that oil tankers will go up in value, but oil prices not. I don't think oil prices are likely to go up and continue to go sideways and even down from the current $40. But that's not the case for oil tankers, I believe. So I think there is a bottom here, and that's why I say, okay, if it drops 10%, what is the chance that it drops another 10%? It's very low because we are at PE ratios of 4 for these companies. The amount of earnings, profits that they make is about the same as in a year as the value of the company in certain cases. Or maybe, a little bit less, but the PE ratios are already very low, so you can't continue to go down in valuation of these companies. Right now, the shipping rates have already collapsed a lot, and so they make a lot less money than they used to during the Corona crisis. But then still, the amount of money they make with current shipping rates is, causes still there to be very low PE ratio. So I say, okay, sure, it can drop another 10%, but the chance is just low. It's only 20%. And if you fill in those numbers, that's a very high expected return of 400%. The time frame for this is always like, it depends a bit. In crypto, it's 2-3 years, but in shorting gold, it's 10 years. And in oil tankers, it's 5 years. So that depends a bit on the investment. Maybe I should change that in the future and have the same time horizon for each. So I can bump this up. Corona stocks. I like that very much. I have ignored this when the first investment I make was actually in oil tankers, because I thought the case was strong. Like, why invest in companies that are on the verge of bankruptcy? I mean, that's high risk. Better to invest in oil tankers. They make tons of cash thanks to Corona. But the problem, of course, is that, if you look at it from a different angle, Where is the opportunity? It's actually in companies that are on the verge of bankruptcy. The risk is much higher, that's true, but it's also a once in a lifetime opportunity that you have in these cruise lines and airlines. They are hit so hard by this crisis, and the question is, will it be structural and continue to be, or will this fly over? And I think it's very, very likely it will fly over. Like, people are not going to stop flying or flying less. No, the people always fly more over time. And this corona crisis will just make it worse. If you forbid people to fly for half a year, what will they do after? Well, very likely fly double as much. So I think, and the same is true for these cruise lines. But of course, cruise lines is a more difficult category because that's really some kind of like culture in vacationing that may change over time. But flying is not just vacationing. I mean, flying is mobility. And of course, we always become more mobile and we commute more over time. That's just a statistical fact. Corona does not change that. So all these airlines that are tumbling through the floor, I think are great opportunities. I have 3 of them here. SAF is Spirit Airlines. Azul is a Brazilian airline, and NAS is a Norwegian airline. Yeah, great opportunities, I believe. The question is, how much is the opportunity? Well, I think just looking back, recovering to the old all-time high is about 200% from here for these companies on average. Let's take this one, Spirit Airlines. It's an American company, Spirit Airlines. We have revenue. Revenues, it's a budget airline, very cheap flights in the US. Revenues went up a lot. Very important. You want to see growth in companies. That's why I'm scaling back CCL, Carnival Cruise Lines, because the growth is not good of revenues over time. I have a 5% exposure, but my aim is to basically bring this down to 0. But this other cruise line does have a more acceptable growth. It's the 3rd biggest one, the Norwegian cruise line. Carnival is the biggest one, but the growth is not good enough. And what they've done during the crisis is important. Did they sell off ships? Yes, they did. And so it's more difficult to grow back to previous highs when you sell off infrastructure. But Spirit Airlines, yeah, great growth in revenues in 10 years from 800 million to 3 billion. That's good. How much percent change is that? 400% growth in revenues. So revenues continue to go up. Of course, they collapse due to Corona. If you look quarterly, then it's not such a pretty picture. Revenues do collapse. But okay, this will just, that's a V down, and that will likely be a V back up. Or maybe slower, yeah. It's a slower recovery of revenues, but it will very likely be back up here. Some airlines do go broke, so the ones that do survive get the business from the other ones, and so I think it's wise to ignore these collapses in revenues, and basically assume that they will be back up here in 1 to 2 years. And because of pent-up demand, not only will people fly again like before, they will fly even more. So the continuation of growth of revenue is likely, and will surprise to the upside as much as it surprised to the downside. And these kind of events are also once every 10, 20 years that happens in the airline industry, some disaster. Um, but so bad is very rare. So okay, the opportunities were of course the biggest 6 months ago, but of course I embraced other opportunities there. Those times have passed. A company like this was worth 5 billion, went sideways, worth 4 billion for over 5 years. Basically, it was around 4 billion. Um, and then it drops to less than a billion during Corona crisis, and we're back at 1.5 billion. So we're still at half the valuation that it used to be over the past 5 years. Huh? And then you have to dig into these companies. But in the case of Spirit Airlines, yeah, they have delayed some orders. They ordered lots of planes, 100 planes for expansion during this period here, but they were able to delay those deliveries. Their financial position seems okay. Yeah, very okay actually. Despite collapsing revenues and earnings, they are able to keep their head above water. And I continue with their expansion plans, which is very important. Because we're aiming this year, the 4 billion valuation, the 5 billion valuation. That's why we invest in this, to see that valuation come back. And that can only happen if they continue their expansion policy as they did before and don't scale back. That's the case with Spirit Airlines. So yeah, potential is double to 3 billion. But actually, the wise thing to do about investments like this is you buy them now and you keep them for 10, 20 years. You don't keep them just to go back to a recovery. You keep them as long as they are well run, and they do a good job. You keep them in your portfolio. And what you do is you borrow against them if you want to invest in other things, but you don't sell it off. So yeah, the potential here is a 10 billion company. You can in 10 years. But okay, you do have to find some kind of like average for these companies. 100% you could say, but that's too little. That's just going back to the previous valuation. 200% I think is fair. Upwards potential. And that is if they collapse another 10% again. But after they collapse another 10%, what's the chance they collapse again 10%? Well, of course, I mean, the low was half of where we are. We did go ×2 already. If there is back Corona fear, then of course this it can give back half of the gains it made. It can go back to like 1.2 billion or so. That's possible, but you can't make it that probable. What's the probability? It's not a majority probability. We are still like these airlines, for most people, still look very bad. The amount of traffic on airlines is only recovered to 20-30% of what it was before the crisis. It still looks bad from a distance, these airlines. So that's, you want to be ahead of the market, ahead of the pack. And so yeah, I think it's fair to say, okay, if it drops 10%, what's the chance it drops another 10%? You can't say it's 50%. It's not a toss-up. We are creeping out of the crisis. It's a minority chance that it drops another 10%. Huh? It's not a majority chance. Huh? So 30% I think is fair. And then Kelly says, okay, invest this 70% of your portfolio, but you take half Kelly normally. And I would say in this case with Corona, well, this is a unique scenario. So you can do a little bit higher than half Kelly. Let's take 60%. So that's a recommended allocation of 40%. So let's take 35%. That's the goal, to be 35% allocated. I'm already 20% allocated. So I want to add another 13% allocation if it drops 10%. And then how much do I allocate to each company? That depends. It's just ballparks. But I think you should invest big in great opportunities, like a great managed budget airline that is valued attractively is not easy to find. For example, you get a Ryanair in Europe, it's already went up too much. That's a very well managed airline, huh? But yeah, in Europe, the budget airlines, there's more competition there. I think it's a more difficult sector than in America, but I could be wrong there. Just don't see a great budget airline like say Spirit Airlines seems to be a great one that's still valued interesting. So 10% allocation. And then we have Azul, but it's Brazilian, so less capital is following and pumping Brazilian companies. But the same story as Spirit Airlines. So let's take a little bit less. Let's take 6%. And then we have maybe I should keep some CCL, because I don't want to go 8% to NAS, which is a Norwegian airline. That's a little bit too much. But that company is total disaster. They did have to scale back a lot. They issued 2,000% more shares. So they were able to basically force all debtors to take shares instead of getting their debts paid back. And so they printed lots of shares. And so the previous shareholders only hold 5% of the company today. The 95% of the company, of the new shares, is now owned by leaseholders that own the planes, but now and had lots of money owed to them, but now they don't get any money. They only got shares. So they got lots of shares that they're dumping in the market, of course, and that causes the value of the company only be 300 million right now, something like that. But it's also growth very, very fast. No, I'm wrong with that market cap. I should really know this. Problem is, this is quoted on the Norwegian stock exchange. I should find it out. If anybody could post below the market cap of Norwegian Air Shuttle. But they did grow very fast in revenues, expanded very rapidly the past 10 years. But yeah, they had some disasters happen to them already before the Corona crisis that caused a downward spiral. And yeah, the shareholders lost their pants on it. But it used to be worth $200 for a share, and now it's less than $1. Sorry, it's not dollars, it's NOK, crowns, Norwegian crowns. Cut by 200. So they lost it all, the shareholders. But this company can't go broke, I think, because well, they have no debts anymore. They're all converted into shares. And well, yeah, that's of course good. If they don't go broke, that means they will survive, and they are very ambitious. They did do a very aggressive expansion in the past, and they still have a fleet, and they probably, once the economy recovers, will become aggressive again in expansion and have a good chance to go up. But the dumping of shares will likely continue for a while. But yeah, you catch them low, put low bids, and you can build a position. I have a 1% exposure to it now. But I hope to increase that, but not so much. So maybe I should keep some of this and not sell any more Carnival. But it all depends on opportunities, other opportunities that I find. But I think that this should be a lowest exposure because they fucked up so badly. much lower than a well-managed budget airline that has not been on the verge of bankruptcy for many years now, which is the case for Norwegian. But yeah, I just stack that up like this as targets. And then we have tech. Tech is, of course, very interesting. So I plan to buy more Zillow. I have not invested in it yet. I hope it corrects. It just went up a lot. The low was $20, and we went to $110 the past year. Crazy price rises. Here, we went to $60 twice the past 2 years, and then we collapsed to $30, $30, $30 several times, also during the Corona crisis. But now we went to a new high, not 60, the old high, but we went to 120 almost. So double as high. So this pumped a lot recently. Let's take revenues also quarterly. Zillow is the website that the Americans use to find real estate. It's a really amazing website. And I think this is a really great company. Quarterly, revenues went down a little bit, not much during the Corona crisis. No. So, but the future here is, of course, like selling a house, such a big problem. But on Zillow, they try to, like, most people in America really use Zillow, so they have a huge network effect to their advantage. They almost all use it, and because you have such good data there to see, it's really a fantastic website. What's the value of your house, and even the houses around you in your area. You can study their past price histories and sales prices over time, and just such a valuable website. And of course, people put it up for sale on that website, and yeah, network effects plays a lot here. But then they also really expand their services. Like, you can actually sell to them your house for a low price, yes, but it's just one click of a button. That's been their goal also. Sell your house with one click of a button, or buy one with one click of a button, and do it all on the website. Very difficult to realize, but it's the future. Like, if I see these real estate brokers, what a waste, and how expensive they are. 5% of the value of that property goes to them or so. I mean, and the amount of work they do and the value they add is very little, I think. Like, these are the kind of industries that I think should change a lot with the rise of the internet. They still work like there is no internet, these brokers, and I think that will change. And a company like Zillow is on the forefront to profit from this, and they also implement the right services to do so. So they basically, with one click of a mouse, you can sell it to them, but I mean, you don't get market price because you get the best price to sell for one click, but it's the lowest price. If you try to sell yourself, you can get a higher price, but it may take you half a year or a year to sell. You have to do lots of work to the house to make it in a saleable condition. You have to pay the real estate agents. Like, there's all, with one click of a mouse, sell the estate as it is, and they bid you maybe 20% lower or so, but it's sold. And more people start to use those services, and this is, of course, great revenue. And they also then own lots of houses, but they have structured as such that they have little financial risk, because there are other companies behind it that take the risk. Banks, of course, they are government companies. They will take on all kind of crazy risk for low fees just to get more revenue at these banks, because if they go broke, they don't care, they get bailouts anyway. So yeah, Zillow, a great company, and okay, the market cap is 20 billion now, but this company can go a lot higher. Companies like Facebook are valued 500 million, um, but 500 billion. But what do? They just sell ads. Huh? Where is you can make most money selling ads or in real estate? Real estate are huge transactions. You take a small commission, you make lots of more money, huh? Like the amount of users that Facebook has in America is about the same than the amount of users that monthly users that Zillow has, 200 million a month. Which one is going to make the most money over time? If they're able to monetize that well, they'll make a lot more money than Facebook over time, huh? But Facebook is valued a lot higher. And then there's of course also international expansion. That's not really on the forefront at the end of Zillow, but once you have a great system, you can because all these countries have the same problem with real estate. Huh? Even much more so, because if you don't have a website like Zillow, well, you do have to sell it yourself. Then you are forced to use also a broker if you don't want to get too many headaches. Yeah, so I think amazing company, great potential. Yeah, but I would try to buy cheaper. It just pumped a lot. Um, you can also turn the story around and sell it as a very risky company, actually, because they own lots of real estate. Some people perceive this as a risky company. And when the market does, that's a great time to buy, but that's clearly not the case right now. But the danger of waiting for corrections, of course, that you miss out on an amazing opportunity here, because yes, it's worth 20 billion, but it's been worth 10 billion, huh? since 2017. It's a slow growth. You start at 5 billion at IPO, 10 billion a couple years later. We're now at 20 billion. It's normal growth. Huh? If you look at the revenues were 200 million. It was worth 5 billion. That's quarterly. Let's take annual. Guys. So the revenues annual 300 million. They are 10 times higher in just 3 years. Huh? That's crazy. Huh? 300 million revenues, and now it's 3 billion. So it went up times 10 in revenues in only 4 or 5 years. In 4 years, it went up times 10 in revenues. And the thing is about this is that it can do easily another 10x in revenues and another 10x in revenues, huh? Because of the market it is in. And the position it has. You can't just easily beat something with a strong network effect like Zillow. You can try to start your website with real estate. You can't compete with Zillow. Huh? That's too late. That window has closed due to the network effect. So this may be just the start of a company that will go a lot higher in revenues and therefore also valuation. Great investment, I believe. Different from Twitter. I invested 10% in Twitter. But Twitter has also good revenue growth. That's if you add Twitter here to compare. Yeah, not so much. Huh? Twitter is a bit stagnating in revenue growth compared to Zillow is just continuing to go higher and higher. But Twitter is more like a slow grower here in revenues. Yeah. But it all depends since when, of course. Since 2016, yes. Since 2014, no. Yeah. But which should have the highest exposure? It's not Twitter, you see? Twitter should not have the same exposure as Zillow. Zillow is a much better story than Twitter. Twitter is another let's sell ads company. That's limited amount of money they can make. And they're stagnating. The past is the best indicator of future performance, is past performance. So yeah, I have to change this one. Zillow should be higher, Twitter should be lower. So maybe we should sell some Twitter for and aim some more Zillow. And then ARKG is just an uncorrelated investment. Genomic Revolution Fund, I talked about that before. But the question is this correct? What is the potential? Yeah, a 5x of such a company, even a 10x, that's the potential. If it corrects another 20%, yes, a 5x certainly potential. What's the chance it corrects another 20%? That's not very high. For fast-growing companies, can't count on that. It's a very low probability. You could say it's only 20% chance. So recommended allocation, but I would take half Cali because it just pumped already. Is then only 40%. Okay, so let's target 35%. But yeah, also another investment that's worth to go on margin for, to borrow money for, to invest. Yes, you can do that. If you have a portfolio consisting of many different investments, a very big crypto position, investing in shorting gold, oil tankers, Corona stocks, tech stocks. Yeah, it's like many different investments that have each on their own a great risk reward. Yeah, you can borrow money against that because chances that they all do poorly at the same time and that loan brings you into trouble is very low. The chance is much higher that at least one or two will do well, and so you won't get into trouble with the margin loan. Cash, according to Kelly, should be at 0. You should not own any cash today, never. But okay, I would say that it depends on general market also. If there's euphoria and there's clearly like something very there's clearly euphoria in the market, okay, you may want to have a cash position. Or if there is yeah, a meteorite heading your way and people are oblivious of it and in denial about it, okay, you can also build a cash position. But there are rare scenarios. You maybe once every 10-20 years you have such a scenario, but usually you should not have any cash because it's not a good investment. Investing in the US dollar is not very wise. You're investing in politicians that print more of it every day and put in their pocket and live the good life, thanks to you investing in it. They are thieves and you pay for it. Cash should not be part of a portfolio except in rare cases, and we don't have such a rare case today. And Kelly confirms that. What's the expected return of cash? 1% interest. Okay. And you're 99% sure to get your 1%. Yes, that's true. But there's also 1% chance, a very low chance, that you lose it all in a hyperinflation or something. And so Kelly recommends to hold 0% exposure to an investment like that. But yeah, if you follow the Kelly criterion and see different kind of investments, and you make sure you never overinvest, based on the probabilities, and you have 4 or 5 investments like I do here, then I think that yeah, you can go on margin and even have a negative cash. Let me know what you think of my estimations. If you think they are wrong, I would be curious about that, because that's very important. Because if I have some estimations wrong here, then of course I overinvest and I may lose. Thanks for watching. Have a great day.